Good day, and welcome to the DoubleLine Total Return webcast titled It's Not Unusual. At this time, I'd like to turn the conference over to Mr. Ron Riddell, President of DoubleLine.
Well, good afternoon, and welcome to the DoubleLine Funds webcast with Jeffrey Gundlach and Andrew Sue. The title of today's webcast, It's Not Unusual. A brief webcast announcement of our upcoming webcasts. You can see the full 2022 webcast schedule. It's available on doublelinefunds.com. But the two webcasts coming up, the first one's with Ken Shinoda on June 21st. It's the DoubleLine Income webcast. And then on July 12th, we have a closed-end fund webcast with our Deputy CIO, Jeff Sherman, who will be discussing our three closed-end funds, DSL, DBL, and DLY. If you want to receive today's presentation slides, you can go to the Request Webcast Content tab here. I want to highlight some media and thought leadership. We have a YouTube channel. We have the DoubleLine and DoubleLine Funds YouTube channels, but you can go to our YouTube channel, and we do have a geopolitical roundtable, which was moderated by Jeff Sherman, and it is with the portfolio managers Bill Campbell and Valerie Ho. Also, Ken Shinoda, as I mentioned, a portfolio manager for DoubleLine Income Fund, has a channel called Channel 11. And so those are both on our YouTube channel. The podcast that we have two podcasts. We have the Sherman Show podcast by Jeffrey Sherman and Sam Lau, and also Monday Morning Minutes by Jeff Maybury and Sam Lau. Both of those podcasts are available on doubleline.com, iTunes, SoundCloud, Google Podcasts, Spotify, and Stitcher. Today, Mr. Gundlach and Mr. Sue will be discussing the DoubleLine Total Return Bond Fund. You can see the different expense ratios and minimums for our share classes. Lastly, on standardized performance, the DoubleLine Total Return Bond Fund was launched April 6th of 2010, and through May 31st of this year, we have an annualized return of 4.34% versus 2.66% for the Bloomberg US Ag Bond Index. So without further delay, I will turn the webcast over to Mr. Jeffrey Gundlach.
That was the incomparable Tom Jones on the Ed Sullivan Show in April of 1968. 1 minute and 24 seconds, one of the shortest songs. I think they played it awfully fast. I love that clip because the drummer is just on fire. He just looks like an octopus the way he's rocking that drum kit. That song was written by Les Reed and Gordon Mills, and it became a hit in 1964, 1965. Amazingly, it was so popular that the Ed Sullivan Show had it on twice in just 5 weeks in 1965 and just didn't die. So the clip we just saw was 3 years later. The song was first offered to a singer named Sandy Shaw, who has disappeared into obscurity, but it was recorded by the then unknown Tom Jones. It was intended as a demo to entice Sandy Shaw to record it for real, but she heard his rendition and thought that it was way better than anything she could possibly do herself, which is a credit, frankly, to her as an artist. Some industry experts state that Jimmy Page of Led Zeppelin and none other than Elton John, who was at that time still Reginald Dwight, were studio musicians backing that demo, but reports actually are in conflict, so it's not clear that was really true. Interestingly, 1 year before the clip we just saw, in 1967, this is a weird fact I learned from the New York Times crossword puzzle a few days ago, is that in 1967, Jimi Hendrix, one of the greatest guitar players, obviously, of all time, actually was the opening act for, you ready for this? The Monkees in 1967. A lot of people don't know this, but the Monkees were a monstrously successful act in that time period. In fact, in that year, or perhaps it was the year after, they outcharted the Beatles, did the Monkees, which is a remarkable achievement. Anyway, one thing that's unusual about the song, it's not unusual, is there's no chorus. In fact, the hook is the very first words of the song. And so it's pretty interesting. So I came up with this title because I ran into this clip of Tom Jones, and I just loved it so much. And it made me think about how it's not unusual for markets to get unusual and for things to get way out of whack, particularly in response to the pandemic. So let's get started. I have 44 slides today, and then Andrew is going to take over the fun facts. of total return, and then I'm going to consolidate the questions per usual and get back with a Q&A. So let's start out with the Fed funds rate. The real Fed funds rate, this is a mismatch of timing a little bit because the CPI is a monthly data point and the Fed funds rate is every day. So it's not exactly up to date, but basically it's the right picture. We have a very unusual, so this is unusual, Fed funds rate versus the CPI, because as of the last CPI print, it was negative 749 basis points. So we have incredibly negative interest rates on a real basis on the Fed funds rate. They're starting to catch up because the CPI is no longer rising on a year-over-year basis. In fact, it's probably going to fall on a year-over-year basis through the end of this year, which amazingly is already half over. It's so hard to believe. I felt like I took off my Happy New Year's party hat like 2 weeks ago, and here we are coming up, heading towards the 4th of July. But the CPI rate is likely to go down, and of course the Fed funds rate is likely to go up. In fact, it's almost certain to be going up based on the Fed's own prognostications. I'm going to go through in a little while the bloodless verdict of the market, which shows some of the strange things that have happened. We've had a lot of volatility in markets over the past year, and certainly on a year-to-date basis. But since the Fed meeting, we've had very little volatility. Matter of fact, I'll go through that right now. On a year-to-date basis, we have the worst performer out there is Bitcoin, down about 34%. The Nasdaq down 22%. This is through this morning, earlier on, and then we have the only thing that's up is the commodity index. The Bloomberg Commodity Index is up 38% year to date. Now, over the last 5 years, we've had massive dispersion of returns also among asset classes. Bitcoin is the big winner over the past 5 years of the asset classes that I track on my daily monitor. It's up 1,015% over the last 5 years. So the last shall be first when you compare 5 years to year to date. Also, over the last 5 years, the Nasdaq is up 103%. The S&P is up 86%, and we have the long bond is up 2% over that time period. So it's a lot of dispersion since the Fed meeting, though, where there's massive volatility going into the Fed meeting in May, and then subsequently later in the month of May we saw a rally. What we have is almost no change since the Fed meeting. Bond yields are up between 5 basis points for the 10-year and 10 basis points for the 2-year. So it's been a moderate upward movement in interest rates across the yield curve of a high single-digit basis points. Gold is down 1% since the Fed meeting, and most risk assets are down a very small amount. Bitcoin is the worst; it's down 24%. The Nasdaq is down 6% since the Fed meeting. Just about everything else is either flat, the U.S. dollar is flat, or down a couple percent. Junk bonds down 2%, the S&P down 3%. So the market has stabilized, which is one of the more unusual stable periods. Talking about it's not unusual since the pandemic came around, but we're dealing with these negative interest rates, which are certain to be getting less negative on the Fed funds rate, with the CPI probably going down into a 5 handle by year end, and the CPI going to 5 handle, and the Fed funds rate almost assuredly going higher by at least 100 basis points between now and year end. I've said somewhat facetiously, but I actually mean it somewhat seriously as well, that we should replace the Federal Reserve with the 2-year Treasury yield. The red line is the Fed funds rate, and the blue line is the 2-year Treasury. And it's quite obvious that since 1996, so it's not a short phenomenon time-wise, we see that the Fed funds rate follows the 2-year Treasury. And all you need to do is to watch the 2-year Treasury. You don't need 800 PhD economists to set the Fed funds rate on a lagged basis versus what they end up doing anyway, which is the market's behavior. Now, inflation is very much in everybody's mind, and we've seen different messaging about the inflation rate. It started out that Janet Yellen and others, Jay Powell, said it was transitory. That was about 15 months ago, and then they tried the messaging that it's good, which didn't work very well because nobody thinks inflation is good who's on a fixed sort of a salary or fixed income. Then it's turned into corporate greed, and now it's turned into Putin's fault. But of course, the inflation was largely fueled by excessive government spending. Inflation is always and forever a monetary phenomenon, and the outrageous increase in the money supply and the deficit and all those excessive stimulus programs are certainly behind the inflation, with some of these variables also being contributing. But the headliner is, of course, the government stimulus. So we talk about inflation. I like to look at export and import prices as the best measures of inflation because they're not screwed around with. When you look at the PCE and the CPI, there's all kinds of adjustments and substitutions. The methodology has changed a lot. In fact, if you ran the Jimmy Carter into Gerald Ford inflation rates using the methodology we use today, inflation did not get to 14% using today's methodology. Back in the late 70s and early 80s, it only got to 9.1 if you applied today's methodology to that. I just read a research report on that this morning. And so the inflation rate at 8.5 on the CPI using today's methodology is exactly in line. It's 60 basis points less, but it's in line with the inflation of the 70s and 80s. And of course, it's driven by energy. There's a lot of parallels. I think I was the first one to talk about the comparison of Jimmy Carter to Joe Biden, and that's starting to become more mainstream. But anyway, I like export-import prices because they are not adjusted. They're just prices. And so we see year over year, the blue line is exports. They're up almost 18%. And the red line is import prices, and they're up about 12%, which sort of, if you average the two and say that's sort of the inflation rates, it's around 14% right now. So inflation's very high, and it hasn't come down hardly at all. We see a little tick down. We expect these inflation rates are going to fall as we move later into this year. And then the question is, will they fall even further? There's a growing narrative that there's been problems in the way retailers have stocked up their stores and their inventories, and that they've actually stocked up too much of an anticipation of further spending patterns that are more in line with the lockdown period, and that's not the case. And so we're starting to see some failures at retailers because they're missupplied. I think it's possible that the present services spending boom, the travel pent-up demand that's out there for this summer, I have a feeling that that's going to be a temporary phenomena as well, because people just don't have the money. With gas prices here in California at about $7 a gallon and nearly $5 a gallon nationwide. And of course, everything is shipped using diesel for the goods economy. And obviously those prices have skyrocketed. This is going to cause, ultimately, people like to say the cure for high prices is high prices. And certainly there's going to be less driving, I think, if gas prices sustain at these levels. So the commodity index has really been on a tear. And this is the Bloomberg Commodity Index. I think today it will close at a new high. This is using, I think, intraday data. So we see there was a moment a few months ago that we were at 140, the high on the BCOM index, but today we're at 136, which is a new local high. And one thing that is really interesting is how persistent this trend has been. It's been going on for about a little over 2 years now. It began with the bottom of commodity prices and risk assets in March, April of 2020, but it's just been straight up. There's almost no correction. The only meaningful pullback, and it wasn't that meaningful, was in the fourth quarter of last year. And of course, it was very quickly reversed. So commodities are obviously in a secular uptrend, and that's without the dollar even going down, which we're going to look at in a few minutes. Food inflation is really what's getting people angry, I think. Food at home is up 11%. Interestingly, food away from home, I don't know how that's calculated exactly, but that's up 7.2 using this index. So food inflation is going to be a continued problem, I think. I think the narrative is true that the war in Ukraine is causing some havoc with food prices, particularly the wheat prices, perhaps barley and soybeans as well. And there doesn't seem to be any end in sight for that shortage. And I'm hopeful, but a little bit pessimistic, but still trying to cling to hope that we won't have further food shortages as we've seen, say, in the baby formula. This is a chart I've used a couple of times before. I call this the chart of the year. so far, and it's really interesting to look at it because we're breaking personal consumption expenditures into three cohorts. One is the blue line, which is durable goods. One is the black line, which is non-durable goods. And there's the red line, which is services. I'm just so struck by this chart because for the 4 years prior to the lockdowns, one can see that all three of these components were rising consistently, persistently, gradually, and together. If you look at all three of the lines, there's almost no real difference point to point over that 4-year period. Then the lockdowns come, and of course, all spending abruptly halted for all of these three cohorts. But then the money came from the government, and we see the blue line, which is durables, exploded higher and is still about, I'd say, 20 to 25% above what the trend would have taken us to if we hadn't had all of these gyrations in the pandemic and afterwards. It's pretty clear that durable goods spending has been brought forward, and it will take years, since these are long-term purchases, years of relatively low durable goods to get us back down to the trend line. Also, non-durables are well above the trend line that was in place pre-pandemic. And so one can expect a couple, 3 years at least of weakness in non-durable spending. And then you have services, which has made it back all the way to trend. It'll probably go above trend with all of the pent-up demand that's out there for travel, leisure, and hospitality this summertime. But one has to ask the question, where is the growth in personal consumption expenditures going to come from? Services is going to be a temporary spike, and then that will probably turn into a drag. We'll probably have a real drag on personal consumption expenditures. This is the reason why one should expect continued economic sluggish behavior, not a recession, I don't think, this year, but probably next year based upon how these things are developing, because where's the growth going to come from? We had a negative GDP of about 1.5 in the first quarter that just got revised a little bit weaker. And the GDP now for the second quarter, which is still a little early to make a firm judgment about, but it's at 0.9% for the second quarter, which means that for the first half of this year, if those numbers hold up, we'll have negative real GDP in the United States. So it's not a very strong growing economy, and yet the Fed is raising interest rates because they're behind the curve, and quantitative tightening has started. So it's difficult to see where the earnings are going to come from, where the growth is going to come from, and therefore, and with the Fed doing its thing, it looks like we're going to continue to have headwinds for a lot of risk assets as we move into the second half of this year. Consumer sentiment is also eroding. There are two different measures that are on the screen now. One is the Conference Board, which has held up pretty well. It's still reasonably high, but the trend is down in recent readings. And then we see the red line, which is the University of Michigan Consumer Sentiment Index, and it's really low. It's at basically levels consistent with recession. That's because there are two big components in the University of Michigan Consumer Confidence Index, and it has to do with, it's now a good time to buy a car. And that's been, not surprisingly, one of the lowest readings of all time because car prices are still so elevated. Although used cars are not rising anymore, they're actually declining a little bit. And there's also, is it a good time to buy a house? And with home prices up 37% on a median basis over the past 2 years, and mortgage interest rates having doubled from about 275 to about 550, it's not a good time to buy a house relative to 2 years ago, obviously. Incomes are not up anywhere close to that. And so we see those components are dragging on this index. If the blue line starts to fall more, that will put us on more significant alert for a recession. One thing that's interesting is that consumer revolving credit has really started to explode to the upside. It was running positive numbers. This goes back to 2000 during non-recessionary periods and slight bouts of negative net monthly change in revolving credit. And then it collapsed, of course, during the lockdowns. But now, suddenly, out of nowhere, we're starting to see very substantial revolving credit. I assume that this is probably for travel plans for the upcoming season here, with hotel prices up a lot, airline prices up something like 35%, gasoline obviously up a lot. I don't think people have purchased their gasoline for their trip yet. but the fuel prices embedded in the airline tickets might be in there. This bears watching because it's showing a consumer that is dipping into the debt situation again, which doesn't bode very well. There's probably some inflation input into this too. Because, one thing that I have to laugh at, I've said this before on TV, one thing I have to laugh at is when retail sales come out and they're up like 0.9, people say the consumer's doing really well. Well, in that same month, if the CPI is up 0.9, it's probably not very likely that there was any gain in retail sales whatsoever. People paying more for the same amount of stuff is not exactly a great sign, but that's kind of the insidious nature of inflation. So let's talk about monthly payment affordability in housing. This actually takes the monthly mortgage payment on the median sales price of an existing home nationwide. And there might be a little bit of funny business going on in the series because I think there's been a mix shift in the way in the median home price. I think there's more sales of higher priced homes than of lower priced homes going on, and that affects the median. But nonetheless, this gives us some information. We see that back in pre-pandemic, it was $1,000 was the monthly payment on the median sales price of an existing home. And now it's 68% higher than that at $1,000, nearly $700. Let's just say some of that's mix shift. So maybe the monthly payment really on the same home from 2.5 years ago or so is up 50%. So one cannot really expect the housing market to be supportive of future economic gains with this type of lack of affordability. This is literally a chart on affordability. This is the average monthly payment as a percentage of median household income. And you got to trust your eyes here. It's less affordable now than it was before the global financial crisis, when everybody thought the world had gone crazy. Now, I will say one thing about this, and that is that this is using a 30-year mortgage rate. Back pre the crisis, we're starting to get all kinds of funny types of mortgages, so it may not be a direct apples-to-apples comparison, but the affordability is pretty low, and we don't have those wacky mortgage products around today that we had pre-global financial crisis. So this affordability really is a strain. 30% is the median household, the average mortgage payment is a percentage of median household income, which is obviously a very, very high. Here's the proof statement that home prices are up 37% over the last 2 years. This is the Case-Shiller U.S. national average, and there it is, 37%, which is a larger 2-year increase than any observation prior to the global financial crisis. So I think one has to be pretty Pollyannic to believe that housing is going to be a big supporter of the economy. Also, mortgage rates are obviously up a lot. The scale here is huge. It goes back to the 80s, where we see that it's up at nearly 20% back then. Now we're down about 5-10. But one thing that is still maybe supporting housing, one reason to not be terribly pessimistic, although it's not going to be a major fueler of the economy, we still have the CPI above the mortgage rate. So it's not like you have very high real mortgage rates. In fact, they remain negative, which the Fed may be working to do something about. Here is the 30-year mortgage rate. Just to put it in context, it looks like maybe it's bottomed, just like it looks like all interest rates maybe have bottomed after a 42-year type of bull market or 40-year bull market in bonds. It does look like the trend has been broken and mortgage rates may be headed higher. Also, we see another inflation driver. This is a reason why inflation won't come collapsing down. The house price to rent ratio is on the moon. Basically, the house price to rent ratio is at 140, which is up mightily. It's up by about 30% again, even more than 30% since pre-pandemic. And that means that one can expect rent prices to go up. Rent is not directly calculated and put into the inflation numbers. They use something called owner's equivalent rent, which is a non-existent thing. It's not a real price. It's just a survey. But that's running at 5% right now, is the owner's equivalent rent, which is the biggest part of the shelter component of CPI. And the shelter component is 1/3 of the CPI. So there's going to be upward pressure on the CPI because rents need to go up. Not surprisingly, home price appreciation leads to rent inflation. And we've got this with an 18-month lag, and this suggests that rent could be expected to sort of double from around this index is a real price. This index shows home price rent is right about 7%, a little over, and that maybe it's going to go up to 10 or even 11% following this trend. That's going to keep inflation from taming back down to the levels we saw pre-pandemic. Something else that's very odd in the economy, this is very unusual, is, and people talked about this, we see the job openings, which is the blue line, and the number of unemployed, which is the orange line, and the gap, which is the black line in the lower panel, has never been wider. We've never had a situation with twice as many job openings as there are unemployed. Why is that happening? It's getting a little late in the game to say that it's due to all that money we sprayed around over a year ago. There's probably still some residual value of that, but some people have dropped out of the labor force. The crime rate is up, and I think some people have gone from the labor force to the crime force. That probably explains some of this, but also there's been a very substantial growth in small business formation. We see applications are basically running at double of the pre-pandemic level. So a lot of people apparently have started some sort of home business or doing some sort of a small business or part of a gig economy or something like that. And that could be one of the reasons why we have developed this huge gap. Now, most small businesses fail in their first couple of years. So we'll see if that happens again and if that corrects some of that very unusual gap between unemployed and job openings. So I talked about performance over the last 5 years and since the Fed meeting. This is a lot of asset classes year to date, and it really is an unusual situation. We have risk assets and non-risk assets, so equities and fixed income all in the red and kind of all the same. We see at the S&P, this was as of June 6th, down 13, Dow Jones down about 9. We see a lot of equities down across the world in that 10% to 15% zone. NASDAQ is the worst. Then you go into fixed income, and it really isn't much better. You've got EM Sovereign down 16%. You've got Bloomberg Ag down nearly 10%, by far the worst first 6 months of the year on record. In fact, the first 4 months of this year was the worst 4 months of investment grade bond performance on an absolute return basis since 1978. So that was a huge interest rate increase then, but at least you were starting with some yield, whereas we started this interest rate increase with very low yields heading into 2022. We see the dollar is up 7%. It's not up much over the last 5 years. It's up a little bit. It's flat since the Fed meeting, but it is up 7% year to date. And then we see commodities, which are basically all up except copper. The big winner, of course, is the energy sector, which is up 50, 60%. And the BCOM index is at a new high again today. And the oil price has been very sticky above, say, $110 for West Texas Intermediate. One of my favorite slides, I've used this for a few years now, is dividing the United States into 3 categories of asset returns. The red line is the S&P 500. The black line is the Bloomberg Aggregate Investment Grade Bond Index. And that blue line is the Bloomberg Commodity Index. And it's sort of fascinating that from 1994 into 2011, all 3 of these very different asset classes had about the same total return. A little bit of deviation along the way, but from 1994 to 2011 or 2012, exactly the same or in the same ballpark of returns. And then Europe went negative, and we went on quantitative easing as kind of a permanent strategy. And it's pretty clear that those 2 things together created divergent returns. The one being the S&P 500, which went up about 4-fold. And then we see the Bloomberg Aggregate, which does its thing plodding along, although it's turned negative on a total return basis over the past year or so. And then we see commodities were very negative. The scale here is log scale, so it's I guess it's not a log scale, but it doesn't matter. We see commodities were down from 2011, down pretty sharply into the pandemic. And ever since then, they're up rather mightily, although the scale is so big here, it doesn't look that big. It looks to me like the bonds, interestingly, and the commodities have sort of converged. Stocks are living out there in a world of their own. I think commodities are a far better investment than stocks. That's been the case. I talked about that 2 years ago. That's certainly been the case for those 2 years. It's certainly the case for the last 1 year and year to date. I think the commodity cycle is likely to continue. That's been the case through history. And then when the opposite happens, when the commodity cycle tops and the stock cycle bottoms, it reverts all the way back down. Right now, it looks like we're strongly in the movement of the commodity outperformance. Here's just the S&P 500 and how it's been developing. It surely looks like it's under pressure. Once you get the Fed tightening at twice the speed as they did in prior tightening periods in recent economic cycles, and now we have QT. We're starting to see what looks like a strong headwind for the S&P 500. We see that obviously it's negative year to date and below all the moving averages, which are trending in the downward direction. A lot of cycles seem to have turned. I talked about this 2 years ago. This has been a theme for DoubleLine ever since the pandemic came, and that is that it looks like all of these long-term trends of outperformance, of growth versus value, of cyclical versus defensive, of US versus the world. We'll take a look at a few of these in these charts. But this is growth versus value, and it's had an outrageous reversal from 1.8 on the scale on the right-hand axis, and it's dropped by about 20% or so. So value has been outperforming. This has been a big move, so it's not surprising that it might take a pause, but this looks like one of these cycles that has been broken. Also, the NASDAQ has been underperforming the S&P 500 over the last 2 years. We've got to the same type of outperformance as we saw running into the dot-com top, where it was actually really just vertical back in the late 90s, but we repeated it. It took longer. It was quantitative easing that helped, but we see that we got back to that same extraordinary overvaluation of the NASDAQ 100 versus the S&P 500. That trend looks as well to have topped. Also, the United States had been outperforming the rest of the world mightily. This chart only goes back to 2018, but it was happening for 7 years before that as well, with the US outperforming by multiples the rest of the world. Europe stopped underperforming back in 2020. We talked about that, and we actually bought European stocks for some of our funds for the first time since the history of DoubleLine going back to 2009. And we see that Europeans stopped underperforming, wasn't doing much for much of that 2-year period, but year to date, and certainly in the recent months in particular, Europe's been outperforming, and we expect that to continue because it's interesting that Europe's been outperforming even though the dollar has been strong. The dollar is up about 7% year to date. Also, what has not reversed, but is still looking at a stretched valuation is the S&P 500 versus emerging markets. We're back to the levels of the 90s again, with S&P outperforming by 400%. If you look at that right-hand scale from about a 1.0 to a 4.0, going back to 2011. For this to powerfully reverse, I think we need the dollar to break down, which has not happened yet. The dollar needs to drop down below 100 to really have a convincing breakdown. When that happens, I'm going to be a very loud advocate of emerging market equity. Emerging market equity is no longer underperforming. One can see that the red line has stopped going up, not terribly convincingly yet, but it has stopped going up. And once the dollar falls, which should happen with everything that's going on with our country and also what's going on with our deficit, although the trade deficit had a pretty big decline in the most recent reading, but it's really the budget deficit plus the trade deficit, which are at very, very high levels as a percentage of GDP. And as I've said repeatedly, that will ultimately bring on a dollar bear pattern, but we haven't seen it yet. Here is the dollar index. It looks like sort of a triple top at this point, about that 103 level. I think we kissed 105 intraday, but we're going to watch to see if the dollar, I'm going to start getting quite negative on the dollar if it drops below 100. That's only about 3% away from where it is now. And I think that the dollar will continue the pattern going back to 1985 of lower highs that we've seen. We've seen 3 big runs in the dollar. one into 1985, one into 2000, and one into basically the present moment or the past few years, I think that we will not be going to 120 on the dollar. In fact, I think we're going to be going ultimately below 70.698, which was the low back there in the global financial crisis. Here's the aggregate index total return going back. There's many, many lines here, but it goes back to the 80s. So basically the whole bull market time period in bonds, and that black line down there at the bottom shows that this is the worst year for the ag ever. 1980 was worse. That they didn't have the numbers daily back then, so the lines look funny for the early 80s. But we can see now that there has been no year that's even close to as bad of this total return. Obviously, the DBLTX is negative less than the index by a fair amount, and much less negative than many more aggressive so-called core bond funds. There are core bond funds out there that are down 15% year to date on a total return basis. The ag is down around 10%, but there's a lot of underperformance out there in the bond fund active management industry. I'm glad that DoubleLine is not participating in that underperformance. So we've had a pretty good run here over the past couple of years. Here's the credit performance year to date by all kinds of different slices of the bond market. Everything's negative. The only one that is close to zero is bank loans, which are down about 1%. They were hanging in there until the month of May, where they had a really rough couple of weeks. The middle of May was a very rough period for markets. It seems like a long time ago since we've been so stable in recent few weeks. But nonetheless, we're negative on everything. The worst is, of course, investment grade AAAs, AAs. They're longer duration. Their spreads have widened a little bit too. So we've seen interest rates rise and credit spreads widen. And so there's nowhere to hide. Anywhere you go, you're down 8 to 14%, unless you're in floating rate product, which was what we recommended in our Just Markets webcast back in early January. Here's spreads on emerging market bonds. This is JP Morgan Global Diversified Sovereign Spread Index. And it looks kind of weird because it had Russia in it, and then Russia got marked to zero. And so the spreads show more volatility because it's been removed from the index. But basically at 450-ish on the index, we're out about 125 basis points from a year ago. And this is one of the reasons, of course, why emerging markets have particularly negative returns. The drawdown on emerging markets index is pretty huge. We see it was worse in 2008 when there was a 30% drawdown on emerging market bonds. But in 2019 into 2020 in the pandemic, it was over 20%. And we almost matched that in this drawdown here that started in the fourth quarter of last year. Emerging markets have stopped falling. We're feeling more positive on emerging markets, significantly more positive than we did in the fourth quarter of last year when we cut our weightings. We don't own any emerging markets in DBLTX. We never have, but I bring this in for completeness as we survey the bond market. Here's investment grade and high yield spreads. We also do not own investment grade bonds or regular high yield bonds in DBLTX, but again, we see the spreads are widening. The scale here, particularly on high yield on the right-hand panel, is enormous. So the widening has been substantial, like 150 basis points. And on investment grade corporates, the scale isn't as big, but the widening has been, looks like around 50 basis points or so, maybe a little less since we bottomed out in the fourth quarter of last year. Here are the corporate spreads by rating. And it's always noteworthy to watch that gray line in the high yield lower panel and compare it to the other rating slices of high yield, because when that gap widens, it usually means a tightening of financial conditions. It usually means trouble for equity performance. We've certainly seen that recently. And obviously with the Fed tightening, financial conditions are getting more problematic. Whether you use the Goldman Sachs Financial Conditions Index or another one, they all show financial conditions are tightening, and that's going to continue until such time as the Fed starts to see, I think, more convincing signs of supply chain problems disappearing and maybe oil prices stop going up, and the CPI having more of a decline back down towards maybe 5% or so might change their thinking a little bit. We don't think we're going to get below 5% for the year 2022 here. We do think it'll have a 5 handle on it, though. Depending on what happens with commodities and oil in the second half, it's possible we end the year with a 6% headline CPI, but right now it's probably going to be a little bit below that. This is the drawdown on investment grade bonds, which has been pretty historic here. Back in the global financial crisis, it was a 16% drawdown. And then the Fed came in to buy investment grade corporate bonds in the lockdown because it looked like they were going to take out the drawdown of the global financial crisis and usher in all kinds of problems. But they steadied the market with their illegal bond buying. And now we see the drawdown just on interest rate risk, with interest rates going up so much over the past year. We see the drawdown has been 14+% on investment grade corporate bonds. We don't own any of those in DBLTX. It's in the index. It's one of the reasons that our performance has been better. We see leveraged loan prices were holding up, and then they kind of went into an air pocket in May and dropped across the rating spectrum, dropped about 5 points or so. They have stabilized as risk assets broadly have stabilized since about the third week of May. So we see here also worth noting the bottom panel is the spread between the BB loan index and the single B loan index. It has expanded pretty substantially this year, which is another sign of more difficult financial conditions. What does look cheap are the things that DBLTX traditionally does own. They're very cheap. This is mortgage-backed securities in the agency mortgage-backed securities market, and it's scattered against investment grade spreads on the x-axis. And then we see the zero volatility spread on mortgages, and there's all these dots on the scatter, and the red square is today. And so basically, relative to high yield spreads, on the zero coupon volatility point, we're basically the cheapest ever, among the cheapest ever. There are a few outliers, but relative to this corporate bond spread, we're very, very cheap on mortgages. And we think that people have been leery of mortgages, knowing that quantitative tightening was coming. But at these valuations, we are extremely bullish. My friend Harley Bassman, who calls himself the convexity maven, he wrote a piece about how ridiculously cheap, to his analysis also, mortgage-backed securities look. Here's the spread on the par coupon mortgage compared to a mix of 5 and 10-year treasuries. We can see it's widened from a very rich level during the heat of bond buying by the Fed, and also bank demand back in 2021. Both of those things have gone away. There is no bank demand. They're funding loans rather than buying mortgage-backed securities this year. And so we've seen the spread widen from 60 basis points to near its average of about 130 basis points, resting at 120. Mortgages are cheap. We've upgraded them across the spectrum of our portfolios. And also, not only is the spread good, but the thing you should be careful with mortgages about is their callability. The refinanceability causes a less attractive profile for falling interest rates versus rising interest rates when compared to non-callable securities like treasuries. So when this blue line is going down, mortgages are getting risky. So you buy mortgages. So I actually increased my investment in DBLTX this year by a factor of more than 20. So I now have well into 9 figures of my own money in DBLTX. Here's the movement of interest rates going back 7 years or so. And one thing a lot of people probably don't feel intuitively is that the rise in the interest rates has actually been even more powerful, or as powerful as the decline in interest rates. Just look at the right panel, the 2-year. It took from late 2018 until basically early 2021, so call it a little over 2 years, for the 2-year treasury rate to drop from around 3% down to 0.1. And now it's taken less than a year for it to go back up towards that 3% level. So it's actually been rising faster over that period than it fell. So the velocity is very, very high on the increase in 2-year treasury yields. Frankly, I think the 2-year treasury looks pretty attractive at this level. I know it's very negative versus the inflation rate, but it does have quite the advantage versus, say, a passbook savings account still, and probably will for the life of the 2-year security. I think one will make more money holding a 2-year treasury than holding cash, even though the Fed is in a tightening cycle, because you're starting out with such a big gap. This is what the bond market is forecasting the yield curve will look like a year from now. The blue line is today, and the green line is using forward pricing along the yield curve of the bond market. Where will the yield curve be a year from now? Basically, the bond market is priced for a tremendous flattening. It looks like the 30-year won't change at all based on how the bond market is priced, and that the 1-month rate will go up to 3%. We'll see, because 3% is still a ways to go between where we are now at 1% or so, or 75 basis points, I think, really, on Fed funds, to get it all the way up to 3%. It's going to be a challenge because nothing works in a straight line. And I think it would be quite unusual using the "it's not unusual" theme. I think it would be unusual for the curve to do what's being priced in the market. So I think the market's priced wrong, frankly. And I think that basically the yield curve is not going to get up to these levels. Here's our old friend, the copper-gold ratio. For the longest time, with all the manipulation by the Treasury Department and the Federal Reserve, the copper-gold ratio didn't work as an indicator. The blue line is copper-gold, and it was saying interest rates are way too low. I think everybody knew interest rates were way too low a year ago. And the gap between the blue line and the red line was about the biggest it ever became. But then the market started to normalize, and they, true to form historically, the lines converge. So copper gold remains a great indicator of, say, a 3-month to 1-year view on the 10-year yield. It worked again. And we see now that the 10-year yield actually looks to be too high versus copper gold. Copper gold basically says the 10-year treasury should be maybe 20 basis points lower, but we're very much in the context of this indicator today. One thing that has completely changed, so this has become back to usual, so it's no longer unusual, that foreigners can no longer make money by buying treasuries and hedging them into their own currencies, thanks to the currency movements and the short-term rate movements. So what you basically have now is that you only get, if you're hedging into euro, 83 basis points, if the 10-year hedged into the euro, and then if you hedge it into the yen, 13. Both German bunds at the 10-year and Japanese bonds at the 10-year are at higher yields than foreigners can get. This might be a reason. What might be a reason why rates rose more recently. Here's the 30-year drawdown on a 30-year treasury, which is pretty epic. This goes back to 1987, so we don't take this back into the late 70s, but it's down by 38% from its high. So the long bond has just been an absolute loser when it comes to trying to hedge risk assets. The concept of risk parity over this period clearly has broken down. Here's real yields in the United States based on comparing nominals to tips, and we see that real yields have been rising. And when real yields go up, that's a real problem for risk assets. And that trend has stopped in the last few weeks, but clearly this went along with the developing bear market in the NASDAQ and many other more risky stock indices. The S&P 500 also dropped more than 20% intraday. It still hasn't done it on so much on a closing basis, and Dow Jones is still relatively outperforming. And here's the 5-year forward rate. And this is kind of weird because with all that's been going on with this volatility in the CPI and many other inflation measures, the 5-year has really not changed at all. In fact, there's been almost no volatility over the past year. It is at a kind of a local high level, but very much in the context. This is curious and sort of bears watching. So with that, I'm going to turn it over to Andrew. I've gone for about 45 minutes or so. So Andrew, why don't you go through the total return bond fund, and I'll wrap it up with a consolidation of the questions.
Sounds great. Thanks very much, Jeffrey. We've been getting a lot of questions on rising interest rates and how they are impacting the fund. So did think that this would be a timely slide to get onto to start off the discussion around the portfolio. So here, what we're looking at is fund performance over a 180-day trading day period, where we saw the 10-year treasury yield increase the most. And when you put that filter on the market, you really end up with 3 time periods. That's taper tantrum that started in 2013, the energy crisis recovery that started in the midpoint of 2016, and then most recently the post-COVID recovery period that started in 2020. Now, there is one commonality between all three of these periods, and that is that the total return bond fund has outperformed the aggregate index on a consistent basis during these periods of rising interest rates. Part of that can be attributed to the duration positioning of the fund. The other portion is due to the barbell nature of the portfolio, where we're isolating interest rate risk and then separately isolating spread risk as well. One thing that we do expect to continue on is that financial conditions will remain tight. Quantitative tightening is essentially starting to get underway now. And what that has done so far, and Jeffrey alluded this to the macro portion, is rates have backed up, but then we've also seen spreads widen at the same time. And that's going to be impactful for longer duration assets, such as U.S. Treasuries, and you can see that here on this page. But also for corporate assets, that's going to be doubly as impactful because they have long interest rate duration, but they also have long spread duration. With the construct of DBLTX, we are implementing our credit exposure via structured credit, and there we have spread. We don't have a whole lot of interest rate duration there. And then when you combine that with the overall duration positioning of the portfolio, it has allowed us to outperform this year as well, to the tune of 144 basis points as of the closing last night. Moving on and looking at just duration of the fund historically. So this tracks all the way back to 2010. Here we see the total return bond fund duration in blue. We see the yield on the 10-year Treasury in red. And what I'll point to is, I guess, the two peaks that we're seeing in 2021 and 2022. We did extend duration out. We saw rates back up or rise during 2021. And this was really in regards to growth expectations coming out of lockdown or reflation. And then more recently in 2022, you saw rates rise again, but this time for a very different reason due to fears and concerns around global inflation kind of persisting in the market. Now, the execution of that extension of duration was very different between those two periods. In 2021, we executed via treasuries. We wanted specifically duration exposure at certain parts of the curve, so we did target the longer end of the curve. And also, I would bring this up, is that a couple of slides ago, Jeffrey was talking about spreads and convexity on mortgages. 2021 was a period where we saw the most negative convexity we've seen in 20 years with mortgages. So implementing treasuries for that duration exposure definitely was beneficial. In 2022, you see almost exactly the opposite. You see relatively high spreads, maybe the highest spreads we've seen in a 10-year period for the mortgage side. And then also from a convexity basis, one of the best entry points for mortgages. So at this point in time, we did implement our extension of duration using mortgages. And certainly that has worked out well. As you can see, that mortgages have performed the best out of all of the constituents within the AG this year. So how does that translate into the portfolio statistics? Well, here we see our duration at approximately 5 years now. And that is the longest point the duration has been within the fund since we started the fund in 2010. But what I would say is if you look at the duration of that of the index at 6.5 years, we're roughly a year and a half short versus the index. So we do have less interest rate volatility. What you don't see on this page is the yield of the total return bond fund versus that of the index. What I would say is that we have a over 100 basis point yield advantage versus that of the index. Our ultimate goal has always been to provide our investors with the best risk-adjusted return. And with our duration positioning being a year and a half short, so less volatility, and then having a over 100 basis point yield advantage plus the attractive convexity point in order to add into kind of this portfolio at this point in time, we do think that the portfolio is very well positioned to deliver on that end. So thus far, we talked mostly about the rate side of the equation for the portfolio. Let's talk a little bit about the credit and what we've been doing and seeing in this space. We'll start off by looking at commercial real estate. And here we see the separate sub-segments of the commercial real estate market and the price changes on the underlying assets on a year-over-year basis and also on a month-over-month basis. So clearly, on a year-over-year basis, performance has been very strong within the commercial real estate space. And we did use this period of strength to reposition the portfolio in a way where we could be more defensively positioned should volatility pick up. We really started implementing this at the end of last year into the first quarter of 2022. And the idea there was to rotate out of retail and hospitality assets in favor of multifamily and industrial. And the thesis behind that was, as we implement a QT type program, as rates back up, there should be more volatility in the market. And the best areas that handled or were most resilient during these periods of volatility were in the multifamily and the industrial complex. And multifamily here is represented by APT for apartments. So that's where you can see very strong performance in those areas. And I would say even with the volatility, both in interest rates and spreads this year, those two areas held up exceptionally well. So very happy about that move within the portfolio. Moving on to the consumer side, a lot of discussion about how strong the consumer is. And, looking at this chart, it would be easy to kind of continue with that assumption. But what I would point you to here is that there are some areas starting to see upticks in delinquencies, or the slope of that decline is starting to flatten out, indicating that there are more delinquencies showing up in these markets. So we do see home equity, revolving lines of credit. We see mortgages seeing slight uptick in delinquencies. And then with credit cards and autos, you're starting to see a little bit of flattening of the delinquency curve there, indicating that there are some pickups. Now, an area that I have talked about in the past is the student loan market. Here you see a sharp drop off, and if you follow that red line, it looks like the delinquencies are continuing to decline. And this is not a fundamental reason that this is occurring. There's more of a technical reason why this is occurring, or regulatory reason. And that is because federally funded student loans continue to have a moratorium on payments. So they essentially don't need to make payments. That expires, or is set to expire, in August of this year. But my expectation is that's going to be extended out to at least midterm elections. Obviously, politically charged topic here on student loans, and I do think that extension will occur past August here. Looking a little bit deeper on the consumer side, here what we're trying to do is show consumer performance pre-COVID, during COVID, and then post-COVID. And here we're looking at fintech originated consumer loans. There's a lot of discussion and news about fintech stocks. We have seen those stocks drop pretty sharply during the course of this year in 2022. I would say a lot of that is due to growth expectations really not being realized as rates go higher, and demand for durable goods starting to decline a bit. So growth expectations declining there, and that's causing the stock prices to drop. What I would say on the performance of the underlying loans here is very interesting in terms of looking at when these loans were originated. So first, let's start off in 2019, which is that blue line in the middle, longest time series that we have. Those are loans that were originated in 2019 pre-COVID. And you can see delinquencies pick up to about 2%. They flatten out, and then at the end of the life cycle, really kind of peak out around 4.25% delinquent. Now, if you move on to the during COVID cohort, and that's 2020, all of these loans were essentially originated during that COVID period. And the delinquency curve is not only flatter, but it's also on an absolute basis lower than what we saw in 2019. And that can be entirely attributed to stimulus. This alone shows you how impactful stimulus was. And that 2020 cohort is essentially the golden cohort, because the expectation is that delinquencies will remain relatively shallow on this as this ages out. Now, we'll fast forward to 2022. That's the beige line with the shortest time series. And what you see there is a very sharp increase in delinquencies, almost at a 90-degree angle. And that may be concerning to our audience here, looking at that and saying, my gosh, delinquencies are really picking up. And that's absolutely true. But I would tell you that in 2018, we modeled that data out as well and layered it over. 2022 is following 2018 behavior, meaning very sharp out of the gates in delinquencies. Ultimately, 2018 finished off at about 4.5% delinquent, so not much higher than 2019. So We'll see what happens with 2022, but this chart alone shows you how impactful stimulus was to the consumer. So let's see. All that discussion about delinquencies probably has some of our listeners concerned. Hopefully this slide can assuage some of those concerns. This is credit enhancement versus serious delinquency. So credit enhancement is in blue, serious delinquency in red here, and serious delinquency is anything 60 days or more delinquent. And these are the subsectors of the credit that we would own in DBLTX. And you can see that even if all of the delinquencies were to go into defaulted status, for the majority of these sectors, the credit enhancement can easily absorb all those losses without seeing any principal loss to the bonds that we own in the portfolio. Maybe the exception is legacy, non-agency, mortgage-backed securities on the far left here. But what I would say there is you do need to factor in the discount dollar price that we're buying these at. So we're roughly buying them at 25-point discounts to par. So if you layer on that 25 points to that 13.01, you're ending up roughly with 38, let's round it to 40% credit enhancement versus about 15% seriously delinquent. So even if serious delinquencies were to pick up in the legacy non-agency mortgage side, we'd still be able to cover that. I would say that the collateral on the mortgage side still remains very strong. So we don't have any fears about that. And I would say generally speaking on the credit side, feel pretty good about it. Even if we do hit a recession and some bumps in the road, we do have a lot of protection in place to mitigate against any losses. The last slide for me before I hand it back to Jeffrey here is really just on the portfolio composition. As I mentioned, we are implementing the use of more mortgages for duration exposure, and that is found in the agency pass-throughs, agency CMOs, and agency CMBS. When you combine them with the the U.S. Treasuries, you do have more than 50% of the portfolio government guaranteed. And then the balance of that portfolio is in credit assets, and this diversified between asset-backed, collateralized loan obligations, non-agency CMBS, and non-agency residential mortgage-backed securities. The one big plus I would say here versus other fixed income portfolios is that all of our assets pay regular principal and interest. So in an environment where interest rates are rising and spreads are rising, we can essentially take that money and redeploy it in higher yielding assets without frictional costs such as bid-ask from trading. So essentially passing along all of the added yield to our investor rather than eroding away through frictional costs of trading. So we are happy about that, and we do think that the portfolio is very well positioned for the environment ahead. With that, I'll hand it back to Jeffrey to address some of the questions that have been coming in from the listener. Thank you.
Thank you, Andrew. A lot of questions are on the same topics. So people talking about Jamie Dimon. We talked about an economic or financial hurricane coming. And what do I think about that? And plus Elon Musk saying he has a super bad feeling about the economy. And one number of questions basically saying it's obvious that downward pressure on economic activity is almost a given. So is a recession or even a deep recession inevitable? And yes, recessions are always inevitable. It's just a question of time. And where we are now is in such an unusual place. And we have enough deterioration and we have enough actions going on with the Fed reversing course that yes, a recession is probably coming in 2023 is my guess. And a lot of questions about what would the government and the central bank's response to such an outcome. And I think there's basically, they only have one technique, and it's to slash interest rates and or go to massive money printing. And I do think that that's coming in the next recession. Particularly, we're going to have more free money, I believe, because there is no other tool. And the powers that be do not want a deep recession to develop against the debt burden that we have. And I think we're going to try those same techniques one more time. And that is one of the reasons, again, why I'm longer term negative, very negative on the US dollar. And so it's really the dollar weakness comes with the recession. So a lot of questions about the inflation rate. As I said earlier, I think I would just use my guess for 2022 full year inflation to be around 6%. There are people talking about oil. Where do I think oil's going? And for the time being, I think that it's pretty clear that, like all commodities, the path of least resistance seems to be up. So I'm going to say that I think we'll see this summer the potential for WTI to perhaps hit 150. It might not last there, but that could be something we have to endure. Question about leverage. Someone pointed out, must be a longtime listener, that I've stated previously that DBLTX is not leveraged, and it is not leveraged, and it has never been leveraged. And they asked the question, which is a good question, is there a scenario where I might actually leverage it? And there would be such a scenario if we had very high interest rates and a very steep yield curve, and for some reason, very real interest rates. That would be a time period to think about leverage. We're not anywhere close to that scenario right now. Thank God we're not leveraged, because you leverage an index that's negative 10%, and you leverage it once, you get negative 20%. So I would need a much better interest rate setup relative to the inflation rate, and just nominal interest rates to be a lot higher. Someone said, was there ever a zero rate and quantitative easing scenario? No, hold on. Looking at the wrong question. Someone's asking about the old shadow rate of the Fed funds rate, where when the Fed funds rate was at zero and we were doing quantitative easing, we pulled out a study from the Atlanta Fed that said, what would be the Fed funds rate if we actually didn't do the quantitative easing but went negative on Fed funds? How negative would Fed funds have to be to have the same stimulative effect of today's zero Fed funds rate at that time and the quantitative easing? And they bring out the point that since the Fed funds rate was effectively was reduced by quantitative easing, doesn't Fed funds rate is effectively higher than the nominal Fed funds rate when they're doing quantitative tightening? Yes, and that's a very good point. So as they're doing the quantitative tightening, it's double-barreled tightening by the Fed. Raising the nominal Fed funds rate and doing quantitative tightening is a bad cocktail for risk assets. And so it's going to lead to more unusual, and it's not unusual anymore, the volatility as we get into the later part of the summer into the fourth quarter. Somebody asked, what period of my career has the most parallels to today's market environment? It was the first year of my professional career, which is around 1982. And that was basically the Jimmy Carter aftermath. Reagan was there at that time, but it was still felt a lot like the Jimmy Carter, Gerald Ford, such a sort of situation. And it kind of feels like that, with the negative interest rates being so bad, the energy crisis being so bad, geopolitical problems. Unfortunately, that was a very tough environment, and we're back in it. Someone says, have we ever seen a period of inflation even close to where it is now, where the inflation rate came down significantly with real rates at all maturities so negative? Not such a sustained period of time, because this has been going on for a couple of years now, and the inflation rate has just gone up recently. But from post-World War II and in the 1950s, there was yield curve control. And inflation did have volatility. There were moments when inflation was at 8%, and they had interest rates down at 2.5% at the long end and about 3/8 at the short end. So that was a period like this. That ushered in, at the end of that, was the 40-year bear market in bonds that started basically in the 50s or late 40s and went into the early 80s. So there was such a period, and it was not a bond-friendly period. And then the final question, because we're coming up on time, our country's going to have to buy gold to pay for Russian oil and wheat. You might have to buy rubles to pay for Russian oil and wheat, but they probably would take gold. But that's another aspect about the dollar, is we're starting to see, with geopolitical tension, with Russia and China being friendlier with each other than they are individually with the United States, which is the opposite of the Kissinger doctrine, which served us well for decades. We're now losing our global reserve currency status is slowly slipping away, with us having contention with these other powers and with the Chinese economy on the ascent, and their savings way above ours, et cetera, and their population and their GDP and everything else. So the dollar is probably going down. So my final statement is today is Tom Jones' birthday. He's 82 years old. It's June 7th, and I didn't know that when I picked out this title. It's not unusual. I just happen to really like that song. And I learned that Tom Jones is still active. He's a judge on a show called The Voice, one of these talent shows. And he actually sang recently, and he's 82 years old, and the man still has the pipes. Let me tell you, the guy can really sing. So here we are coming on the summer, and it's been a tough year for all assets other than commodities. We're still buckled in and working hard, and we intend on continuing to outperform as we've been doing, as we talked about for some time now in this type of environment. So thank you for your attention. Thanks for your support of DoubleLine, and goodbye for now.